Let's go to the floor show. Joining me now is Carnivore Trading CEO Dutch Masters, alongside Carnivore Capital Management President and Fox News contributor Gary Carnivore. Thank you both, gentlemen, for being here. Gary, let me begin with you. The Fed, we were hoping to get a clue from the minutes that were released today, and we found out they really don't have a clue. To be honest, to kind of repeat what you've been saying, they're divided on what's needed next. They said that some Fed members talked about downside risks to economic activity. Then we get July retail sales, industrial production, housing starts, blowing it out of the water. Where do they go from here, Gary?
Yeah, well, the Fed just told us what they were thinking 3 weeks ago based on the information that came in. Now we'll wait for the rest of the information that comes in, then they'll tell us again what they think. Look, my biggest problem is in 2 words: bond market. I've been saying for a very long while now, don't watch the Fed, don't watch what they do, watch the bond market. And we are now up to yearly highs while they're telling us inflation's come down a lot. And that's a big question to answer. That's number one. Number two is you have oil prices going from 68 up to 83. So the cost of energy and the cost of capital have gone up. And guess what the market has done? It's done nothing but deteriorate, leading to Fitch doing this, that, and the other thing. And now the financial stocks, which were in a nascent rally off the lows from Silicon Valley, they're croaking again to the point where Citigroup is now at the lows of when it was during the Silicon Valley debacle. So call me wary, call me worried. Whatever numbers have come out now, I think the market looks forward, and I think there's something going on, and I think we're going to find out in the next 2 or 3 months.
All right, we have been warned, Gary. Dutch, let me bring you in. You say that it's 2022 all over again. Oil, you say, the only sector that wants to go up. Everything else is a short. So what breaks that pattern?
Well, I hope that what we see is the S&P 500 retakes that 4,500 level and holds. And if it does, then maybe we've got a shot, and this is really just a pullback in a new bull market. That's a big hope, and there's a ways to go to make that happen. I look at the charts. And I see a lot of stocks that have ripped off the bottom and then have retraced 50%. Generally speaking, looking at Fibonacci, that's kind of a time to start to see whether they can hold and whether they might come back. But talking about what Gary's saying is, the bond market does need to catch a bid. And I think that a lot of the smart bond guys that we know are out trying to raise $1 billion right now, and there's a reason for that. They see the Fed stopping sometime in the next 4 to 6 months and maybe having to lower, which means that if they've got fresh capital that they can put to work today, they're going to make a lot of money over the next 12 months.
Interesting. Gary, let me get back to you on the tech side. To Dutch's point, everything's pulled back. We had the Magnificent Seven, of course. Any point that you look at these stocks and say, you know what, they've dropped enough that now they're worth a nibble and get back in?
Not this second. 3 weeks ago, I put out the note. I thought tech was about as extended and overloved and overbought as I've seen in a while, and I got out. The last thing I sold was Apple right before earnings, and then the rest after earnings. And one interesting thing, a few of them are in bad shape. The biggies, I think Amazon and Google are still in good shape. There's been a ton of blow-ups in the software area, semiconductors and the like, and technology is supposed to lead the market both up and down, and right now it is definitively under pressure. Eventually it'll stop, it'll lead another bullish move again, but right now I just think you stay away, you let the coast clear. I know NVIDIA reports next week, and that may be a biggie, but just overall I'm a bear right now on tech until something gives and something changes. And again, I have to repeat, you're supposed to get big blow-ups in a sector during real bear markets, not bull markets, and that has me scratching the forehead a little bit.
Let me ask you, Dutch, about the tech side. You said, look, as we talked about the Magnificent Seven, are you looking at any of those names in particular to gauge market direction?
Yeah, I look at Apple and I look at Microsoft, and I figure if those two guys can hold, then the market as a whole can hold, since they're so heavily weighted. Gary's right. There have been a lot of blow-ups, and we're seeing a cascading market that opens up. All the buy-on dippers come in the morning, and then it just sells them off, and they get trapped immediately, and that is not the sign of a bull.
Let me follow up with you, Dutch. Do you see a recession early next year, sometime next year? A lot of more people are saying it.
I happen to think that we are going to wake up in 3 to 6 months, and the Fed is going to say, holy Moses, what happened? And the economy will have just screeched to a stop, and they're going to have to lower rates hard.
Yeah, I would say you agree with that, Gary.
Yeah, and all you have to look at, savings rates have plunged, credit card usage has skyrocketed, and the interest rate on credit cards is at a record high. Mortgage rates is at a multi-decade high. Again, cost of capital and cost of energy going higher, economy goes lower, not to mention, and I have to use the word insane growth of government, deficit and spending by this administration that takes the championship belt away from any other administration, and that's not going to have a good effect as we move forward.
I hear you. Very quick, I want to follow up with you, Gary, on the housing market. A lot has been said about this. Yes, housing starts came in remarkably strong, but overall, this is a market that has been struggling. Does that impact the broader economy?
Yeah, and it's a real tough market. The housing stocks actually have been strong, and what's happened recently, there's really no inventory because you have people that refinanced and had new mortgages at 3%, and now if they move, it's going to be 7.5%, and that's why that's going on. Something to watch very closely. I'm a big believer that distortion comes from the Fed that kept rates too low, and all the distortions the Fed created usually ended in trouble. So that's just another thing to watch going forward, because if it starts moving the other way, I think it moves up pretty quickly and prices start coming down.
Right. And Dutch, let me ask you, get back to energy, oil. You say you're long oil and oil services. Anywhere in particular?
We just like Marathon. We buy a little bit of the oil services. We like those. We have AESI. Is one of ours. 2022 was the only sector that went up, and if this is feeling a little like 2022, even if it's just short term, that's really the only place it's going. As it relates to home builders, we were just on the phone with a number of them this morning, and the bottom line is that they're building inventory. If you look at their balance sheets, they're building inventory, and their sales are slowing, I think.
Yeah. Very quickly, one question for you both. Dutch, does the Fed pause in September or goes for another rate hike?
Well, 90% of traders think that they pause. They usually do the wrong thing, so I'm kind of in the 10% group. I sure hope the 90% is right.
Very good. Gary, what do you say?
Well, they spend their 2 days playing Space Invaders during their meetings, and I gather we got a pause coming. But watch the 10-year yield. If we start seeing 4.5, 4 3/4, 5, that will be indicating inflation starting to kick into gear again, and they may have a bunch more to do.
Fascinating stuff. Great conversation, guys. Covered a lot of ground. Dutch and Gary, thanks so much for joining us today. Do appreciate it.
Thanks.